everyone. Welcome back to Build with Shreya, the podcast where ideas and stories inspire you to build something extraordinary. In a recent episode, I had the pleasure to speak with Mr. Ravi Koka, who is the founder and CEO of StockSnips, which is an AI powered platform for sentiment analysis that is reshaping how investors are looking at financial markets today. So, conversation was packed with how AI is transforming the financial decision making, the psychology of the markets, sentiment analysis, and the future of fintech. And this episode, we're going to explore on how AI is shaping the financial markets, the role of sentiment analysis, and finding the fine balance between the human intuition and machine intellect. And plus, we are going to dive into the fintech revolution and the challenges it faces, along with the future of AI and responsible investing. So, buckle up because this conversation is packed with insights that you wouldn't want to miss. So, AI is transforming industries across the board. But when it comes to investing, can one rely on algorithms to make the right calls? The stock market has been long influenced by fundamental and technical analysis. But in today's digital age, AI is becoming and emerging as a game changer. With ML models processing vast amounts of financial data, investors are now leveraging AI driven sentiment analysis to make more informed decisions. Ravi's journey with AI based investment started with a simple yet powerful question: can machines read and summarize financial news intelligently? And this curiosity led to the creation of StockSnips, a platform that transforms financial news into actionable insights and AI driven sentiment analysis scoring. So, recent reports from Bloomberg are highlighting how hedge funds and institutional investors are increasingly relying on AI to take trading decisions. Algorithms are analyzing earnings calls, social media trends, as well as financial news within seconds, highlighting details that even human traders might actually miss. This shift is reshaping financial markets and making speed and precision even more critical than ever. However, there are challenges with AI driven investing, like market anomalies as well as unexpected geopolitical events that can be interpreted incorrectly by algorithms. So, flash crashes as well as algorithmic biases remain concern. And that's the reason experts like Ravi always emphasize on the importance of human oversight over AI driven trading strategies. So the future belongs to investors who can harness AI's computational power while applying human intuition to navigating complexities that machines cannot fully grasp. So let's talk about AI powered investing and the future of financial markets. So now let's talk about StockSnips, that's transforming market sentiment into actionable insights. In today's fast-paced financial world, investors are bombarded with information. Whether it's breaking news, earnings reports, opinion pieces, social media chatter, there is no dearth of data out there. But the real challenge is how to filter out the noise. And so the question is, how can investors extract meaningful information and insights from an ocean of financial news and without drowning into informational load? And so this is the problem that StockSnips was set to solve. Founded on the idea that AI can help investors cut through the clutter, Ravi's vision was to create a system that could summarize financial news intelligently. And so he collaborated with Carnegie Mellon students to create an AI-powered prototype that could scan through thousands of financial news articles and distill them into digestible insights. So the result? A platform that just doesn't read the news, but it understands its sentiment and transforms it into actionable intelligence. Its proprietary memory sentiment decay model is one of its standout innovations. By measuring how long a particular piece of news has impact on stock perception. Unlike traditional sentiment models that treat all news equally influential over time, this model acknowledges that certain stories lose relevance very quickly, while others have a more lasting effect. And so by factoring in that sentiment fades over time, StockSnips is actually able to provide a more nuanced and more time-sensitive understanding of the market trends. So sentiment-driven investing is becoming an essential strategy in modern markets. Hedge funds like Renaissance Technologies and Two Sigma have already integrated AI-powered sentiment analysis into their trading platforms, recognizing that investor sentiment sometimes moves the market much before the fundamentals actually do. So even major financial institutions like Bloomberg and Definitive have integrated the same into their platforms, allowing traders to gauge the market mood real time. And so what sets StockSnips apart is that it democratizes these insights, providing institutional grade sentiment analysis to both professional traders as well as retail investors. So markets are moving faster than ever. So somebody who's just relying on traditional methods are at a risk of losing out. That is where companies like StockSnips really help investors process vast amounts of financial data instantly, leveling the playing field between retail traders and institutional investors. Whether it is identifying the early signs of a market rally or spotting the negative sentiment before a downturn, AI is really revolutionizing the way investors interpret market signals. So, StockSnips operates in a market where AI powered sentiment analysis is becoming extremely crucial for investors. Several companies have emerged in this space, each offering a unique way to leverage AI for financial insights. So, platforms like AlphaSense and Sentio are providing AI powered document search as well as sentiment analysis to institutional investors, helping them analyze earnings transcripts, SEC filings, as well as news reports. Quid uses AI to visualize relationships between different pieces of financial news, enabling traders to identify emerging trends. MarketPsych, another key player, partners with the Refinitiv to provide AI powered sentiment data focusing on behavioral finance as well as media analysis. So, despite strong competition, StockSnips has carved a distinct niche by prioritizing real time sentiment analysis specifically tailored to the stock market movements. While other platforms focus on broader financial research, StockSnips translates sentiment data into actionable insights for equity investors, and its memory sentiment decay model is a definite differentiator. So another advantage of StockSnips is its accessibility. While other platforms like AlphaSense and Sentio focus on the hedge funds and institutional players and have high subscription costs, StockSnips really democratizes the use of AI-powered sentiment analysis by being available to not only professional traders but also retail investors, and it positions it well in a market where individual investors are increasingly looking for tools that can help them compete with institutional players. So, as the AI driven financial landscape evolves, the success will depend on delivering reliable, explainable, actionable intelligence that truly enhances the investor decision making. So, now let's talk about market psychology and the power of sentiment in the stock movements. So, numbers show us a trend, but it's often the sentiment that really drive them. So, how much of the stock movements is rational, like truly rational, or is it just more of a collective sentiment at play? So, stock market is not just a reflection of revenue growth or earnings reports. It's more of a mirror to investor psychology. Behavioral finance has long emphasized that the impact of emotions like greed and fear can impact the stock movements as much as, if not more than, financial fundamentals. Market sentiment alone can create booms and busts defying all logic. So, stock prices can soar on hype alone, or companies can actually face sell off just due to pessimism. So, the core question is, how can investors consider this overall market sentiment while making investment decisions? So, Ravi's research shows that stock movement doesn't only depend on financial data but on a collective sentiment. That's why we see these irrational rallies, even if the fundamentals are weak, market is crashing, or a company is even posting solid earnings. Tesla is a prime example. Its stock is known to fluctuate wildly, not just based on financial results, but on Elon Musk's tweets, public perception, or media coverage. So the investor sentiment can amplify the stock movement a lot, creating price swings that are completely disconnected from the actual business performance. So with the rise of AI, investors now have tools at their disposal that they can use to determine the collective market mood in ways never possible before. So companies like StockSnips, Bloomberg AI, Ravenpack scans thousands of news articles, earnings transcripts, as well as social media posts to determine the collective market mood. So institutional investors like Bridgewater Associates and BlackRock integrate sentiment analysis into their investment decision making. Studies have shown that stocks that have a positive sentiment tend to rise despite weak fundamentals, whereas stocks that have negative sentiment can drop sharply even if their financial health is very strong. So one of the most striking real world example is GameStop's short squeeze of early 2021. So its stock rise wasn't a result of business growth or earnings, but because of a viral wave of sentiment fueled by retail traders on Reddit's thread of Wall Street bets. So the AI-driven trading systems that monitored the social media sentiment could detect the surge in bullish sentiment for this specific stock before the traditional investors could even react. And so certain investors rode the wave before hedge funds had massive losses. And so this event highlighted that AI can be used to understand the shifts in real time in the market sentiment, providing a leverage and an edge to investors who understood its power. So, despite all the positive aspects of sentiment based investing, it carries its own risks, whether it's a dot com bubble or the crypto boom and bust cycle or the meme stock volatility. It shows that markets can be driven pure on hype alone rather than actual substance. So, AI can help quantify emotions but not eliminate irrationality. Now, if a AI based sentiment model is overemphasizing media negativity, it can cause a false sell, or if it is over relying on a hype, it can create a speculative access. So the challenge for investors is to use AI driven sentiment analysis as a tool but not a rule. So combining data with judgment and not following market emotions just blindly. So understanding the psychology behind the stock movements is just as important as analyzing financial statements. So the idea is not to react to sentiments but to anticipate how it will shape the market's next move. So now let's talk about AI versus human advisors and how to strike the right balance. Will AI replace the human advisors or will it be more of a collaboration in the future? As AI based tools become more sophisticated, the investment landscape is evolving. And so the question is, will these algorithms be able to provide the same level of trust, emotional intelligence, as well as strategic foresight as human advisors do? Over the past decade, there was a rise of robo advisors. Platforms like Betterment, Wealthfront, and SoFi promised to democratize investing by automating financial planning at a fraction of cost of traditional advisors. So while these platforms did gain some traction, but the adoption has been slow, especially amongst high net worth individuals. Investors still prefer the reassurance of human expertise, especially during volatile market conditions. So, meanwhile, established firms like Vanguard and Charles Schwab have taken a different approach with integrating AI powered tools without eliminating human advisors. And so, their hybrid advisory models, which combine an automated portfolio management, have a personalized human oversight and that outperform any pure AI based models, both in terms of client retentions as well as financial outcomes. So the future is not just about AI replacing the human advisors, it is more about AI enhancing their human capabilities. So now let's see where AI wins and where AI falls short. So AI excels in areas which require data-driven analysis, and this could include things like pattern recognition, where you identify historical patterns and correlations in the market, or it could be backtesting strategies by simulating the investment performance with past data, or risk assessment, where it provides real-time insights into portfolio diversification and volatility, or it could be reducing bias that eliminates emotional decision making out of investing. However, AI still struggles with emotional intelligence, understanding client fears, goals, life changes, building trust and relationships. So investors still prefer the reassurance of human advisors, specifically in crisis and complex financial planning. And so AI can optimize investments, but it lacks the broader vision that expert advisors are able to provide. A prime example of this is Morgan Stanley's AI powered wealth management systems that uses AI to analyze client data as well as market trends and provide very tailored recommendations to the advisors. So instead of replacing human advisors, it acts as an intelligence layer and it helps the advisors serve their clients more effectively. So Ravi believes in AI plus human synergy. He sees AI as a way to automate the grunt work, like filtering the financial news, analyzing the sentiments, or optimizing the asset allocations, and leaving the high stake decision making as well as relationship management to the human experts. This way, the investors get benefited both from machine efficiency as well as human intuition. So, the most successful financial strategies will use AI for precision and automation while retaining human expertise for trust and guidance. So, the future isn't about AI replacing advisors, it is AI helping advisors be smarter, faster, as well as more effective. So, now let's talk about the fintech revolution, the innovation challenges, and the road ahead. So, fintech isn't just evolving, it is changing the rules of finance. So, whether it is AI based investing, blockchain innovations, or digital first financial services, they are reshaping the entire industry. And so, with the market moving that fast, the real question is who will lead and who will be left behind? The financial industry is undergoing a seismic shift with the AI at its forefront. A recent PwC report showed that 76% of CEOs of financial services are looking to acquire AI driven companies, showing that automation and intelligence driven platforms are not just trends, they are the future. And the battle doesn't stop at the fintech startups. Even legacy institutions are looking to aggressively integrate AI to maintain their dominance in the industry. Ravi highlights a key shift in the investor behavior, with the traditional 60-40 portfolio allocation model losing its relevance. The more young and tech savvy investors are now demanding AI powered dynamic portfolio that can optimize this for risk adjusted returns. And so this has given rise to AI driven thematic investing, ESG funds, as well as hyper personalized portfolios. And so fintech companies that fail to embrace these changes will struggle to stay competitive in the market. Another transformation is the rise of ETFs. Now, ETFs offer more liquidity, efficiency, as well as lower costs, making them a preferred choice over mutual funds. The active ETF market is to hit $14 trillion dollars in the next 3 years, and financial advisors are going towards more data driven strategies where AI excels. And so, by optimizing the asset allocation as well as lowering costs and predicting trends, AI is poised to redefine how financial products are structured and managed. So, while AI is transforming the financial industry, it is adaptability that separates the leaders from the laggards. The future belongs to those who can harness AI's power while keeping trust, transparency, and human expertise at the core of financial decision making. So, now let's talk about ethics and compliance and AI's role in responsible investing. So, can AI be both powerful and ethical in finance? AI is revolutionizing the investing, but with great power comes great responsibility. More importantly, how can we ensure that AI does not unintentionally introduce bias or pose systemic risk to the financial market? So, the use of AI has caught the attention of regulators worldwide, whether it is the US SEC that has proposed new regulations when it comes to ensuring transparency for AI driven financial decision making, or it is the SEBI that is actively monitoring the use of algorithmic trading and AI driven investment models to emphasize that there needs to be a clear accountability when it comes to unintended consequences. So, one of the biggest ethical concerns over use of AI in investing is explainability, like understanding how the model is actually giving the recommendations. Now, AI driven hedge funds as well as robo advisors rely on a black box model where the developers also might not fully understand the decision making process. Now, this raises concerns over investor trust as well as potential market manipulation. And so, if the AI model is prioritizing short term goals over long term financial stability, it might actually amplify volatility as well as systemic risk. So, leading financial AI models are now moving away from speculative predictions to more risk adjusted insights that prioritize long term market sentiment over short term hype. And so, this aligns with the industry sentiment of responsible AI, that is building AI systems that are accountable, transparent, as well as built to support ethical financial decision making. So, another major challenge in AI based investing is the bias that exists in the financial data. Now, if the model is trained on historical data that reflects existing biases, whether it's favoring certain industries, regions, or asset classes, it can reinforce inequalities. And so, fintech companies are exploring fair AI frameworks that use diversified data sets as well as real time audits to ensure that their models do not perpetuate hidden biases. So, the real challenge is not making AI smarter, that will happen automatically, but making it actually more responsible. And the companies that succeed would be the ones that could strike a balance between innovation as well as integrity. So, to conclude, our conversation with Ravi was packed with insights, whether you're a financial investor, fintech entrepreneur, or an AI enthusiast. But if we are to distill it down, here are our key takeaways. So, first, AI is not replacing human advisors, it is empowering them. Even though there are fears around machine taking over the financial decision making, the fact is that AI works better when augmented with human expertise. And so, the best of the fintech innovations that are to come will strike the right balance between automation and human judgment. Second, the market sentiment is a powerful yet underestimated force when it comes to stock price movements. Now, traditional financial analysis involves looking at the financial fundamentals as well as technical indicators, but sentiment analysis, tracking how news and social discussions impact stock prices, becoming increasingly important for modern investors. And so platforms like StockSnips are showing how AI can turn market sentiment into actionable insights. And the third, last, and most important is the use of ethical AI and regulatory compliance, which are a make and break when it comes to long term success. So companies who are able to prioritize responsible AI as part of their inner learnings and the way they developed AI platforms would be set for long term success. So make sure to like and subscribe our channel. I hope, meanwhile, your stocks are soaring, and whether you're using AI or not, you make the right investment decisions. And so, till the next time, see you then.